Welcome back to the Longacres Finance channel. With only a few days of 2021 left, it's a good time to start looking for the best dividend aristocrats in the new year. I have come up with 3 unique, simple strategies for selecting the best dividend aristocrats to invest in each month. The first strategy targets the most potentially undervalued aristocrats. The second strategy targets the aristocrats with the best forecasted future growth. And the third strategy is a blend of the first two. I believe that each of these simple strategies can potentially offer alpha over NOBL, the Dividend Aristocrat exchange-traded fund. I am not recommending any of these strategies, and this is not financial advice. You need to determine what investing route is best for you, but feel free to borrow what you like from my process and implement it in yours. Let's talk about each strategy, look at the best aristocrats for January 2022, and go over the results for each strategy thus far. First up, we have the most undervalued strategy. I use dividend yield theory to determine the current valuation of each aristocrat. By comparing the current dividend yield to the 4-year trailing dividend yield from Seeking Alpha, I can identify the most potentially undervalued aristocrats right now. Investing in aristocrats that are potentially undervalued could lead to above-average returns in the future, should these companies return to fair value. This may or may not happen, and if it does happen, it could take a very long time to see the benefits of this approach. My original hypothesis for this strategy was that it would underperform NOBL in the short term, but offer alpha over a longer period of time. The secondary benefit of this strategy is that it will likely give you a higher initial dividend yield than NOBL. Because when companies are potentially undervalued, based on dividend yield theory, they also offer more attractive dividend yields. Let's take a look at the 10 most undervalued aristocrats right now that will be included in this portfolio in January. We have Aflac, Amcor, Atmos Energy, Clorox, Hormel, Leggett & Platt, Medtronic, AT&T, VF Corporation, and Walgreens. I know that some of you may be wondering why AT&T is still on my list. Well, it's still a dividend aristocrat as of today, and I don't really want to deviate from how I have been making my selections. When the company does drop off the dividend aristocrat list, I will remove it from my master sheet. But for now, it is still included, and I'll let the chips fall where they may. So there are 3 changes from the 10 most undervalued aristocrats from December. Becton Dickinson, Cardinal Health, and IBM have been replaced by Leggett & Platt, Medtronic, and VF Corporation. The chosen aristocrats for January offer an average dividend yield of 3.62%, versus only a 2.4% average dividend yield for all 65 aristocrats. Based on dividend yield theory, they are about 15% undervalued collectively. Last month, when I put together the update for December, NOBL was up 2.15% with about a week left in the month. That final week ended up being pretty terrible, as the fund finished the month with a loss of 1.76%. The most undervalued strategy offered 8 basis points of alpha, finishing with a loss of 1.68%. But December is looking very good thus far. I have computed a preliminary return for NOBL and the most undervalued aristocrats through December 23rd. NOBL is up 4.89%. This also includes the dividend the fund is set to pay at the end of the month. And the most undervalued dividend aristocrats for December are up 9.55%. That's a whopping 467 basis points of alpha. What a way to finish out the year. There's still a week of trading left, but I think it's safe to assume the strategy will beat NOBL in December. 4 of the 10 December selections are up more than 10% this month. Hormel is up 15.39%. Atmos Energy is up 14.49%. Walgreens is up 13.74%. And IBM is up 12.95%. Cardinal Health and AT&T have high single-digit returns of 9.78% and 8.94% respectively. Aflac is up 6.56%, and Bemis is up 5.33%, including its dividend that will be paid during the final week of December. This leaves us with Clorox and Amcor that are underperforming NOBL this month, but not by much. Clorox is up 4.29%, and Amcor is up 4.06%. I started tracking the strategy in August of 2021. So thus far I have 4 full months of data, plus a partial December return. Through November, the most undervalued strategy had a loss of 0.34%, which is 0.34% worse than NOBL that has a flat return during this period. But including the partial December return, brings the strategy 430 basis points ahead of NOBL. If these figures hold, it will be a sizable cushion for the strategy to build on next year. I'll be curious to see how the month ends, and what the most undervalued strategy has in store for us in 2022. Moving on to the second strategy, the highest expected growth strategy. Here, instead of focusing solely on valuation, I focus on the future return potential for each aristocrat. The way this works is that I take the forecasted earnings growth rate for the next 5 years, and I combine this with the current valuation based on dividend yield theory. The summation of these 2 factors points to what type of return we can expect from each aristocrat over the next 5 years. While I don't expect this to be an exact science, I do believe that aristocrats forecasted to grow more in the future have the potential to offer better returns than those with lower growth forecasts. Let's see the top 10 highest expected growth aristocrats for January. We have Caterpillar, Chubb, Ecolab, IBM, Linde plc, McDonald's, Medtronic, Nucor, Cisco, and VF Corporation. So one change from the December selections. Lowe's is replaced by Medtronic. During last month's update, the highest expected growth strategy had a positive gain of 2.41%, with a 26 basis point lead on NOBL. The final results for November were not as pleasing, as the strategy finished with a loss of 2.31%, losing by 55 basis points to the NOBL fund. This was the first loss to NOBL for this strategy after 3 consecutive months of generating alpha. The 4-month trailing return through month-end November for strategy number 2 is 4.22%, which is 422 basis points ahead of NOBL. That's a pretty safe cushion even with the underperformance during November. The preliminary return for strategy 2 in December is 6.16%. Not quite as good as the most undervalued strategy, but still 127 basis points better than NOBL. Only one December selection has a double-digit return for the month. That company is IBM with a 12.95% gain. McDonald's and Cisco are doing very well, both above 9% on the month. Caterpillar, Chubb, Linde plc, and Nucor are also outpacing NOBL during the month, which leaves us with 3 aristocrats that are not doing as great. Ecolab is up only 3.06%. Lowe's is up only 2.25%. And VF Corporation is down 2.48%. I think the power of these strategies lies in the collective returns, and collectively the strategy is doing very well this month. Inclusive of the partial December return, strategy number 2 is now 575 basis points ahead of NOBL, which is a pretty large cushion to have after almost 5 full months. It is also the best performing strategy, but not by a wide margin, as we will soon see with the third and final blended strategy. The blended strategy aims to capture the benefits of both of the first 2 strategies. Here I am selecting the aristocrats with the highest expected growth rates, but I am limiting the selection pool to only potentially undervalued aristocrats. So basically I want to pick the 10 best aristocrats poised for the best future return, that are also trading for attractive prices today. Let's take a look at the selections for January. We have 21 potentially undervalued aristocrats to choose from, and the 10 of them with the highest expected growth rates are Amcor, Atmos Energy, Becton Dickinson, General Dynamics, Hormel, IBM, Medtronic, 3M, Cisco, and VF Corporation. Just one change from the December selections. Cardinal Health is replaced by Cisco. This strategy ended November on a pretty sour note, losing 2.08% and trailing NOBL by 32 basis points. However, even with this loss, the 4-month trailing return through month-end November for strategy number 3 is 171 basis points ahead of NOBL, placing it right in between the other 2 strategies. December is looking great for this strategy, as the 10 chosen aristocrats are up 8.43% versus only 4.89% for NOBL. That's 354 basis points of alpha. 8 out of the 10 aristocrats are outpacing NOBL during the month, with Hormel offering the best return of 15.39%. The 2 laggards are 3M that is up 3.77% and Medtronic that is down 3.56%. But again, the power of these strategies lies in the collective return. It's very difficult to pick the single best stock out of the 65 aristocrats. It's even tougher to do so consistently month after month. But picking 10 aristocrats that collectively will perform well is significantly easier, while picking the best aristocrat would give me a much better return. Picking the wrong one could lead to terrible results. So selecting 10 aristocrats acts as a buffer against that potential downside. Including the partial December return brings the blended strategy to 539 basis points ahead of NOBL. This is only 36 basis points worse than strategy number 2. So things are heating up here between these 2 strategies as we near the end of the year. It's nice to see that all 3 strategies are doing quite well in December, and that they will potentially finish this year, albeit a partial year, ahead of NOBL. I have also been tracking how a buy and hold approach for each strategy has worked out thus far. This is a much more tax-friendly and a long-term focused investing approach to employ with these strategies. Through month-end November, only the highest expected growth strategy buy and hold portfolio is beating NOBL. That lead is quite large at 423 basis points. The blended strategy buy and hold portfolio is trailing NOBL by 80 basis points. And the most undervalued buy and hold portfolio is trailing NOBL by 120 basis points. I have not computed the partial returns for December for the buy and hold portfolios, but I imagine they will also look great compared to NOBL. I won't have this data updated until the end of January, but I imagine the returns will be strong because the individual strategies are doing well. I think each of these strategies can beat NOBL and offer alpha in the long term. I will continue to track the individual strategies and the buy and hold portfolios in the coming months. I'm very excited to kick off 2022 and see what my strategies have to offer. Thank you for watching and see you next time.